Morning, everyone. So welcome to the Financial Markets Panel, where we will focus on the potential influences of climate risk and risk mitigation on the bond, mortgage, and broader markets relative to the local government. We are very fortunate today to have three distinguished representatives from the home mortgage lending industry, our financial planning and advising, and also from our local government, Miami-Dade County Commission. So it's my pleasure to introduce Mr. Wendell Gaertner from Public Resources Advisory Group. He is a Senior Managing Director. Deputy Mayor Ed Marquez from Miami-Dade County, and of course Mr. Michael Daniels from Christensen Financial, and he is a mortgage loan originator. So I always like to hear from the people themselves, so I'm going to ask them to give just a brief introduction of their kind of role and perspective and tell us how often they are hearing these conversations about climate risk come up in their field.
Sure, I'm Wendell Gaertner. I'm with Public Resources Advisory Group. We are an independent financial advisor firm, so we represent local governments in their financial planning and in their execution of their debt. Work across the country. In South Florida, we represent the Miami-Dade County Water and Sewer Department. We're also one of the financial advisors in a pool to Broward County. In terms of the question of how often we see climate change coming up in conversation, not a whole lot. It is not a huge topic. We're starting to see a little bit, but I think it's helpful to understand how the municipal bond market works. And really there's kind of four important participants. There's the issuer, the local government selling their debt. There's the investors who are buying the debt. In the middle of that, there are investment bankers trying to make the deal between the two. And then kind of like on the Greek chorus on the outside, there are the rating agencies kind of throwing in their opinions on top of it. The market has changed a lot over the past few years. It's a lot more regulated. And one of the areas that wasn't regulated before are the rating agencies. They are now under regulations. In the past, they could kind of say what they wanted to under First Amendment free speech. Now they actually have to have some sort of criteria as to how they evaluate. That criteria to date doesn't have a huge focus on climate risk factors. They're starting to talk about it. It's something that they're looking at. It's probably something they're looking at a lot more around the world. They're looking at carbon reduction out of the Paris talks, and they're focused on what industries are really at risk for that. They're looking at coal mining. They're looking at some sovereign risk from climate change, primarily they talk about the Caribbean, Southeast Asia, sort of the smaller countries that are much more on their own. In terms of local governments in the United States, there are a lot of levels, and it's not something that they have factored into their rating criteria at this point. They've always evaluated weather-related risks, but it's always been kind of a one-off risk, and it's been something that has been a short-term risk. Typically, an event happens, GDP, revenues, whatever goes down, rebuilding occurs, those revenues come back up. So there's kind of a short-term dip, but not necessarily a long-term implication. What they are starting to say now is, however, and they're saying the science isn't there yet from their perspective, but as weather-related events start to happen more often, is this something they need to factor in? They haven't done it yet. They're starting to talk about it. The the investment bankers are starting to say, hey, maybe there's a play here. I can make something happen. Maybe I can pitch a catastrophe bond. And maybe green bonds make some sense here. And the investors are really not focused on that as part of their overall driving factor. If there's an event, they may not go, a lot of deals had to be postponed after Hurricane Sandy, but they were postponed. They weren't canceled.
So Ed, you have expertise both from consulting, but now from local government as well. Can you tell us how often it's coming up in conversation from the finance department at the county level?
I think much more over the past couple of years than before. I would agree with Wendell that the municipal financial market is lagging in its understanding and appreciation of the sea level risk. As far as operations, I'm deputy mayor. I'm the finance director, which makes me de facto CFO for the county. So I do work with all of our entities. Obviously, the environmental community over the last few years have been very vocal about the need for us to address sea level rise, the young people in particular, and our politicians started paying attention, and because they're paying attention, administrations are paying attention. The credit, when you look at an entity, a local government like Miami-Dade County, first of all, we're the government of a living, breathing community that consists of multiple cities, consists of a major unincorporated area. Our budget is something like our debt right now is about $14.5 billion. Over half, about 60% of it belongs to our enterprise funds, the airport, the seaport, which are separate credits from our general credit. We have an operating budget of $4.5 billion, which throws a lot into the community, economic-wise. This role of government, we see the role of government as trying to facilitate a livable community across all areas, allowing businesses to thrive, allowing, good communities. So as information comes out on sea level rise and we see the impact on all the different areas, we are becoming much more engaged.
So Michael, can you share from the residential real estate market perspective and as a mortgage loan originator,
Sure.
how often is climate change and sea level rise coming up in conversation?
Thank you, Samantha and Wendell and Ed for being on the panel today, and thank you for allowing me to speak as one of your guests today. So my name is Michael Daniels, and I'm one of the few people you'll meet in the room that's actually from Miami. A lot of people you ask where they're from, and they're from another parts of the world.
We're in Miami.
And
right?
we're in Miami. So
Everybody should be from Miami.
It's good to be here. It's good to be here. And my father was a builder, just a little background. My brother's in CPA. And so we understand that it's a combination of working from the private sector and the government sector and business and the homeowner. So that's kind of this area that I'm going to be taking. My specialty is residential financing. Any questions you have about that, I'll be glad to address those afterwards when the time allows. And a lot of it really comes down to risk, as we talked about in the last panel about the low risk, medium risk, and high risk, whether it be in government or whether it be in the private sector. And the government is a key role in the mortgage industry. And just a little brief background, as we all know, we went through a really tough time in '08. And when we had the big recession here, Florida was ground zero. And this was really the heart and soul of the short sales. And if anyone see the movie The Big Short in the room? Okay, if you haven't seen that, it's something you should definitely see, because it kind of puts things in perspective and has a better understanding of really what happened. And we all learn from mistakes. And as Wendell had mentioned, it is a very regulated industry now. Residential mortgages should be. It got rid of a lot of the bad actors. The people that are in the business now, my colleagues, are very professional. I'm involved actively with the Mortgage Bankers Association of South Florida on the Education Committee. And I'm a big advocate on education and learning. And we're going to talk a lot about the homeowners insurance and flood insurance as time allows. But to give everybody an idea, if you're a homeowner, let's say you're paying $400 a month, $400 a year. That, as of April 1, there's talk about increasing 25%. So that means you may be going from $400 to $500. But that's still not bad in relative terms, because that's all backed by FEMA, right? They're federally regulated. But if you have homeowner insurance, you're probably paying $2,500 to $3,000. So what I'm getting at is if you're here on the homeowners, private enterprise, and the government's helping subsidize that, it's quite a value. So if the government is not involved, it's going to go up. So that's something I want to kind of keep that in everyone's perspective.
So thinking about that and thinking that now that, there's more I don't know what the word is without getting myself in trouble, more responsible actors in your industry, as part of the recovery. Do you feel like they have an interest in understanding these climate risks, and is it part of the conversation that you're having?
It is very important. I mean, we're in Florida. We're at sea level. We're surrounded by water. We're a peninsula. Whether you're in a flood zone or not, it's still, in my opinion, it's still a good idea to have flood insurance. I mean, we're still at a risk no matter what happens. An example I would like to bring out is Hurricane Katrina. I mean, that was just unbelievable, that event in New Orleans. I mean, they were below sea level. If anyone's been to New Orleans, you know what I'm talking about, right? And when you have 80% of the city underwater, that's pretty scary. And we saw that a little bit with Hurricane Sandy. In other words, that was a water event, Hurricane Sandy, and with the subway systems and, and even now it's happening in Houston. So it's a very important thing to have a risk and have the right association with price.
Okay, so acknowledging some of the awareness of risk and the changes in the flood zones that you mentioned, do you feel like there's been an impact to the residential market just yet, or do you foresee that?
Okay, so let's take a look at Broward for just a moment. If you're looking in Broward and Hollywood, East Hollywood, if it's going to rain, it's going to flood. Because it's older drainage systems there, it's a big problem. And if you're out west, not so much. It's more Everglades. The newer developments, they have the roads, they've got the sewage, they're more structurally sound better than the older developments. So it does make a difference where you're living, and the cost, if it gets to be too expensive, a homeowner may say, you know what, I'm just going to have to pay cash for the property. This happens a lot. If they can't afford to pay cash and it's not within their budget, they're not going to be able to buy, and that will bring values down.
So Ed, I'm curious hearing your response. So thinking about these potential implications for the real estate market, how does that affect local government's financial decisions?
Give long and hard thought as to where we're going to put our resources. Sea level rise is critically important. We all know that here, but it's really undefined as how quickly it's going to happen and where it's going to happen. Miami-Dade County is a large geographic area. We have a big coastline, but we have a huge interior that can flood. So we do need the modeling capabilities to be refined so that from a policy long-range perspective, we can start focusing on where we need to spend our money. We also need to figure out over time and with a lot of discussion what adaptations or what mitigation projects are out there that make sense to us. Okay, what's proven and what's not. There's a lot, the word opportunity was used earlier today. Yeah, there's lots of obstacles, a lot of opportunities. There's going to be a lot of pitches being made, okay? So it's just, and pitches are great. I mean, that's the way we share information and government gets educated as to the products out there to help address stuff. But as a numbers guy, as a guy who has to work with our budget department, trying to find where our resources are going to come from, you know, I really like to know what's the best option available out of the multiple options. Couple that with the very hard tasks for our elected officials as to setting the priorities, or, for lack of a better word, global priorities on the local level.
Local, I like that.
Okay, as far as where we are going to spend our capital dollars. I know water in Miami-Dade is a big issue. We have a $15 billion capital plan just for that right now. That addresses a lot of the issues for sea level rise. But, you know, I have to worry about our airport and our seaport and the like. And these are major economic engines. And that's not to mention the crime and, you know, all of everything else on a social side, health and safety of our residents, our hospitals and the like. So in the grand scheme of things, a venue like this is a wonderful thing from my point of view. It's allowing government to talk to one another. It's allowing private sector come up and talk about modeling and the like and what's out there. And hopefully it allows us and we get the interest of our local businesses throughout the counties, okay, to start saying, hey, they want to participate so that, yeah, eventually it reaches down to our residents and they get an understanding that, yeah, this is going to be a long-range process. It's going to be probably very expensive, and there's still a lot of uncertainties out there.
Perfect segue. So I think, Wendell, you had introduced how you have observed bond ratings kind of follow or how they've reacted to events. But thinking about the long range that Ed has introduced and the repeated potential of repeated events, how can you kind of expand on how you expect those ratings to observe?
Sure, and although you would think that if you're issuing a 30-year bond, that there's a long-term 30-year time horizon, that tends not to be the case. Things and ratings tend to be focused on now. Investors tend to look at kind of their current rate environment, the current ratings. the cash flows in or out of their funds. It is not a long-term horizon. And if you were to come up and say, listen, we've got $100 million, and we're trying to figure out what's going to make the best use of our rating. Should we go and do some retrofitting so that we'll save $150 million if there were an event? Under current analytics, under the rating agencies, you're probably better off just holding on to the $100 million in cash, because one of their rating criteria is liquidity. And historically, that's how they viewed catastrophe events. Do you have the liquidity to bridge? Because we talked earlier about there tends to be a cycle. So can you last that cycle? Can you operate until you get your insurance funding in? Can you operate until FEMA gives you reimbursements? And under the current criteria, which they now have to use their criteria as the rating guide, that's really what's driving the rating. It's three things that are kind of catastrophe related. The first is liquidity. Do you have sufficient liquidity to handle short term? The second is, especially from a local government, and Ed talked a little bit about water and sewer and airport, and those are viewed differently. But in terms of local government ratings, do you have the tax base to support from the long term? And that's, is it strong enough? Is it high enough that you can weather the storms? Is it such that if there were an event, will people come back? Will people be able to come back? Will they be able to get mortgages? Those are the two that are more quantitative, liquidity and your tax base. And then the one that is more quantitative is, what are your plans? And that's where some of the discussion tends, and you saw some of the earlier rating slides where they talked about resiliency plans and those sort of things. That's where they come in, but that tends to be qualitative, not as important to the rating agencies in the overall rating factor. So right now, there is not a long-term horizon out there. And if you were trying to go in and say, what's the best rating right now, it's probably looking at the current criteria, figuring out where you could fit into it, and the important things are liquidity and your overall tax base.
If I can add, we just got our general obligation ratings reaffirmed. In fact, our outlook was improved in Miami-Dade. We're a AA. And not one question was asked about our sea level rise. Now, what is important for the rating agencies is that they rate us as having strong financial management. One of the reasons why we have strong financial management is because in each one of our enterprise funds, we have very long range 30-year plans on how we anticipate rates to go up, how coverage is going to occur, what we anticipate in our capital plan. Our capital plan in our major enterprise funds are throwing in what's necessary to be resilient. And we modify that as more information comes out. Okay, and then will there be an incremental change to our planning on the financial front? So it's all interrelated. But at the end of the day, at the moment, there is not a separate category that says, hey, you have sea level rise resiliency plan. There's no checkbox for that.
And to follow up on that, the rating agencies are at least starting to talk about it. The bond investors, that's really not something they buy or don't buy because of that. And a long time ago when I started in this, it was explained to me, I think it made a lot of sense, is that when you're selling a municipal bond, you're not selling a new car. They just can't look in the factory and say what it is. You're selling a used car. It's been around, it's got some mileage on it, and you're trying to sell it. And the bond investors are buying a used car. And what they're trying to do is they're buying it at the best rate. So they're going to find every little ding. I mean, if you take that analogy and say, okay, the car runs, it's going fine, maybe it's not the prettiest. You can sell that. After Katrina, the car wasn't running for a little while, and they weren't selling at all. But in most cases, when you're looking at it, it's really how do you polish the car? How do you get rid of the dings? And those are the things that can help, but it's not as important as, do the brakes work? Does the engine work? Can I steer this thing where it needs to go?
I'd like to answer one of the questions that Wendell had brought up. Will people buy after a catastrophic event? And especially in Florida, the answer is absolutely yes. How many people were here for Hurricane Andrew? Just by a show of hands. Okay, most of the people in the room. Okay, 92, August. And to me, Andrew was a game changer for Florida. It was a wind event. It wasn't a rain event, it was a wind event. And, you know, that was the first time where a lot of us understood who FEMA really was. It may take them 5 days to get here for the federal troops, but they did arrive. And so help did come, it came slow, and what I'm saying is a lot of people moved, that's from Miami up to Broward and Palm Beach. That was the first growth of that era, like Weston became big as a result of Hurricane Andrew. The good news is, with the weather being as good in Florida versus Toronto, I mean, it's 70% of the time it's sunny, partly cloudy days here versus 44% days in Toronto. So what I'm saying is people want to come to Florida because of the weather, not for the rain or the wind or the hurricanes. They want to come for the sun and the beaches. So it is important that we rebuild quickly and not scare away our tourists. If you guys recall, in January, Lake Okeechobee was flooding, and they had to drain the dikes, and it should be between 12 and 15 feet. And what happened was the runoff goes to the east and goes to the west, and you know, all of a sudden you're a tourist and you start seeing brown, tea-colored water. You go, hey, what's happening? You feel like it's polluted, and all of a sudden you tell your friends back home or your family. It may deter people from coming to Florida. So the environment is very important from a person that's coming here, bringing their money here, like, because we don't really have a sales tax, right? We just charge a bed, we're relying on the tourists as a big driving force. And also, that tourism creates second home opportunities. And we need the second home buyers. They're not getting the homestead exemption. The investor's not getting the homestead exemption. And it has certainly brought up real estate values, which is good for everybody in the room.
Great, and I just want to follow up real quick, Ed. You had described our financial resilience thinking about long-term planning, but now thinking that we've learned from Andrew, we've learned from some of these other events. What's our financial resilience to short-term, like to events or regular tidal flooding?
We have a heck of a lot of insurance right now. Not as much as I would like, but everything, it's, you know, there's a equilibrium that needs to be met between, you know, insurance costs and everything else that we have to fund. We have ample cash in the bank to handle us in the short term. Historically, there would be a cash outflow on whatever the need was, and then we would be having sales tax receipts increase the following year. It's the jacuzzi effect that occurs for big catastrophes. Now, I do agree with the comment earlier in one of the earlier sessions where it was said that, you know, the federal government's is going to be stressed out. And I do believe that's going to be the case, and that over time, we're going to have to be more on our own. My personal thinking is that over a fair period of time, we're going to almost be acting like a little city-state, because the other sources dry up or they don't care. You know, people can move out of Miami-Dade County or out of Broward if they so choose. It's up to us to make sure that they want to stay.
Thinking about flooding, Michael, I'm wondering if you can share if the volatility in the flood insurance rates recently has affected the mortgage process at all.
Okay, it's an excellent question. So, as I mentioned, FEMA was started in '79, and because of Hurricane Katrina and Superstorm Hurricane Sandy, we're $24 billion in debt, this particular program. So that's a big factor as far as cost goes. So that's a big issue right now. In Florida, and it's about 35% of all policies in the country are written here in Florida, like 1.8 million versus 5.1. So Florida is a big area, like, for flooding, even though we haven't had any major floods yet. I mean, our last big storm was Hurricane Wilma, right? It was 2005, again, as a wind event, but we need to be prepared. At some point, we will have some flooding issues, not if, it's a matter of when, and as the mayor said, and how much it's going to cost. We have to keep putting those reserves and be proactive and not reactive.
Great, thank you. Ed, how would you say that these changes in flood insurance rates or the extent of areas flooded factors into how you prioritize local government projects?
We're taking a look, we're doing inventories of our capital projects as they stand now to see what we're building and how it can be made more resilient going forward. So we are diverting our capital money towards that cause. I do believe we do need to do a lot more modeling before we figure out where, where we're going to put a lot of our operational money or other capital monies if we're ever thinking about either raising taxes or rates or seeking other government's help in that area. But just right now, I don't think we have the enough science to say definitively this is where we should put these resources at.
Wendell, could you share some examples maybe from outside of the state, thinking about how these, whether somewhere else that's experienced the long-term impacts or maybe has started the adaptation investments and how that's affected their markets?
Sure. One of the ones that I found really interesting, I was involved in the early end of a water district in California that, as you know, there's a drought in California, and sitting here in Florida, I just thought, well, gee, there's not enough water. But they actually were jump-starting a major project looking at a public-private partnership because they needed to build some deep injection wells to get water back underground because the drought was drying out water so much that they were having the land was starting to sink on a widespread area, which you can imagine has a huge impact on the buildings and everything. So there are some reactions there that they're having to take that are not necessarily planning far ahead. It's that these sort of things are all of a sudden making changes expensive changes required very quickly. What we saw from a rating perspective on New Orleans after Superstorm Sandy, the 2005, they were, S&P had New Orleans rated at triple B plus. After the storm, they were downgraded to double B, which is below investment grade, which is very unusual for a U.S. municipal government. And they spent 4 years below investment grade. It was just last year that they actually got above their pre-hurricane rating. So there are, although earlier I talked about, they're looking at the short term. Once it happens, there are significant costs and there are long-term implications for your borrowing costs going forward.
Coming back to you, Michael, I'm thinking, how would you expect the lending community to view the initiation of having more disclosures for tidal flooding or climate risks?
Currently, when someone buys a residential property and they get financing and not paying for cash, the criteria is you get an inspection on the property, you do an appraisal on the property, and you do a survey and you do title. Okay? So the appraisal is pretty much the first line of defense with, as far as if you're in a flood zone or not, it's going to be indicated on the appraisal. And then the second factor is the survey. It's called a flood elevation certificate, as everyone knows, and then that will give the exact zone that it's in, and then it's risked on that basis for the insurance. So on all of the disclosures now around the United States, you are required to disclose if you're in a flood zone or not in a flood zone, and it is mandatory to purchase if you're in a flood zone.
But how about thinking about tidal flooding? So maybe something that's not accounted for in
It really
FEMA
has
flood
not really come up, unfortunately, yet at this point. Unfortunately, as we know, things happen and then we react, like a knee-jerk reaction. So I guess if something happened major, then all of a sudden they re-look at it and then more disclosures.
As we're talking about disclosure from the bond market, I found this as I was doing a little bit of research, and I wouldn't have come across this otherwise. It was a report about 2 weeks ago from the Financial Stability Board Task Force on Climate-Related Financial Disclosure. This is basically an international group of central banks, Treasury, kind of the big boys around the world, and they were trying to put together a task force on how do you disclose climate-related risks. It was chaired by Michael Bloomberg, and they came out with 7 overriding principles. Again, this is geared towards kind of a international disclosure. What it made me realize is I have never seen once on a municipal bond issue any talk about climate change or sort of risk disclosure to investors based on that. I don't know if that's something that may happen in the future, but it is not something that our market has really factored into as a risk that should be disclosed to investors, other than project-type financing risks, which you disclose and you talk about having insurance to cover those risks.
Coming back to Michael, you had mentioned are you differentiated between a cash buyer and someone that's pursuing a mortgage? I don't, if you know offhand, but I know many of us have read a lot of articles about how high the number of cash buyers is today. And are you saying that that has an influence over the owner's responsibility?
Right. So what happens was, let's go back a little bit in history. In 2008, if someone had a loan on the property they lived, and let's say the property was $300,000, and say the value went down 50%, $150,000. So there's a big difference between what you owe on the property and what it's worth. And where the models came in, when someone lost $100,000, there was a high chance that loan was going to go into short sale or foreclosure or deed in lieu of. So that's, when the markets went down, a lot of investors came in for cash. Rather than put the money into the stock market, they took money out, IRAs, there's a lot of self-directed IRAs buying, and a lot of investors would buy these properties, fix them up just enough to resell them. And that was one aspect. So you're seeing a lot of cash investors coming in. And even today, if a bank has a property and they're entertaining an FHA loan with 3.5% down for a buyer that may have to wait 45 days versus a cash buyer that can close within 10 days, even though the cash buyer is coming in lower than the FHA financing, the bank will take the cash buyer.
So Wendell, I don't know if you know, but thinking about the other financial products available and the other investments that are being made, does having a larger population of cash buyers improve our financial resilience, or does it have another impact?
From the municipal bond perspective, it is discussed, South Florida in particular, having international appeal to buyers, is seen generally as a credit positive because it is bringing money into the local economy. But it's not something I've seen a lot of focus on or discussion on in other places. I think Miami might be a little bit unique in that regard, or South Florida a little bit unique in that regard.
Okay, maybe staying on financial products. I know that you've done some research for us, and you have experience with the different financing mechanisms that we could pursue for adaptation. Do you want to share maybe some of the pros and cons when thinking about what we implement?
Sure, and really there's not a lot of different types of products. There is, for municipalities, there is the bond market. Now there's nuances within that. There are certain things that can be done taxable, certain that can be done tax exempt. There's, depending on the credit you put, if it's a revenue bond, if it's a general obligation pledge, there's nuances within that market, but that doesn't necessarily have any impact on resiliency. That's just the regular method of financing. There are a couple of things, some of which were talked a little bit earlier, that are coming up. I see them kind of as the investment banking part of the market that I talked about, looking for things to bring together. One of those we talked about is catastrophe bonds. We have had some of our clients have been pitched, at least in Florida, have been pitched the concept of catastrophe bonds. I haven't seen them do any. And that concept there is, just as we said earlier, is instead of paying money for insurance, pay money for this bond that's really not a bond, but this financial product that if a certain weather-related event happens, you will be paid. Concept works similar to insurance. I think the issue or the reason we haven't seen that happen a lot is that market is not really that efficient. We talked about kind of being a hedge fund driven thing, something that's attractive to investors because it's not correlated with other financial risks. And that's true, but that really hasn't been a large efficient market. And the insurance market right now, the P&C insurance market is efficient, has a lot of capital, and rates have been attractive. If that were to change, then maybe you might see something different on the catastrophe bond market by individual governments. The other thing that we're starting to see more of is, and around the world, is the green bond concept. And that is, you are making investments that are green in nature, that are sustainable, that have, you provide environmental benefits. Washington, D.C. did one for a 100-year tunnel as part of their water and sewer system. We're starting to see more and more, there are entities that will evaluate and give kind of the good housekeeping seal of approval that yes, this is a green bond. You pay money for that, so you're paying some money to do this. I think one of the rating agencies just announced that they can be providing that service. We've seen some interest. We've seen some of those. It's definitely something to look at. What we haven't seen yet is investors willing to pay a higher price for your bonds, allow you a lower interest rate because they're green bonds. We've seen perhaps more interest, and all things being equal, I think there's a lot of investors that would like to say, yes, we own green bonds, but that hasn't necessarily transferred into, yes, we're going to pay you more money for your bonds that are green bonds. Again, those are relatively, both of those are earlier in the market. It is something to watch. There may be some value there, but it's not a way of going, gee, I've got to do some resiliency projects. I'm going to go issue green bonds, and it's going to be really cheap, and the market's going to eat it up. It's not there.
Local governments, certain cities in the Miami-Dade County, and Miami-Dade County is about to get into it. It's PACE program, basically property assessments that homeowners can access, can work with an entity, borrow funds to put in certain type of qualified improvements, sun, wind energy efficient items within on their households, and get that paid through special assessments, which is a boon to the homeowner, because of the fact that, if they sell the property, that portion of that obligation needs to be paid back in the future. So it's a great mechanism for having electricity generated at home. If there's wind turbine technology ever comes up, maybe that can be something that we can use. Any type of retrofits that's necessary that would save electricity will work in that regard as well.
I'm curious, Michael, has PACE become a topic of conversation in
Not
the
too much,
market
but
yet?
there are programs that, as I started to say before, like if someone's looking to buy a home and the government owns the program, owns the loan, like Fannie Mae, I've heard of Fannie Mae, so it's called a Fannie Mae home buyer program. So they would give the home buyer that's going to live in the property first opportunity to purchase the home versus a second home buyer or an investor. So like a 15-day window that they give them, which is a good thing because we need home ownership. It builds a tax base, and it builds better stability to a neighborhood. And we have a good neighborhood, we have good education in the community. So it helps to have stable housing and stable jobs.
So thinking about the conversation we've had today and then the framing that was provided this morning, I'm wondering if each of you can share your perspective, or actually your expectations for local government in order to ensure our financial markets are sustainable. Do you want?
I do think that there's going to be more presentation to the market of resiliency. I think Ed talked about that was not a box that was checked. That was not something that was presented. I do think that as local governments start to invest, and you'll see investments here today, and have something to talk about, that would be part of the presentation to the rating agencies. That would be part of the potential information to the investors. But I think from a financial market perspective, that's more of the qualitative. That's kind of polishing the car. I'm not sure that it's going to drive any major changes in the overall municipal bond market.
Ed, what are you expecting local government to do to ensure sustainability?
Talk a lot.
We're good at that.
No, and continue on processes like this and trying to connect the dots across the board. We talked about silos earlier, and it's true that governments historically have been siloed. The computerization of government is helping us break down those silos so that we can manage information better across departments. However, our funding sources are all siloed. I mean, our grants are siloed. When we get state money, it's for a specific purpose. Who has the money makes the rules. And so we have to, over time, talk about how we make our money more fluid between projects. But again, we're a community, living, breathing organism that everyone's going to have their say, and this is a democracy, and God thank us for that. A lot of conversations, a lot of evolution needs to occur.
Mm-hmm.
Michael, what are you
Sure.
expecting from local government?
Well, what I'm seeing in Dade, Broward, and Palm Beach, we're getting close to build out. There really isn't a lot of land available that they're allowing, like wetlands are not building them. I'm saying a lot of homeowners are moving in with each other. We're seeing, especially with the population increasing more and more, so it's becoming more of a financial situation, and it's a lot of issues as far as the flooding goes, and if there's a big wind event, then I think you're going to see more of these disclosures and more involvement. It takes it more serious. In other words, there was a time when they asked the president of Harvard about education, and I think it's relative here. He goes, "What do you think about the cost of education?" And he goes, "I think if you think education is expensive, try ignorance." And that's something we cannot afford to do with the environmental issues that we are facing today and in the future.
Great, thank you. Well, we intentionally did not provide formal presentations because we wanted you to have a chance to have this face-to-face conversation with the experts that we have here. So I'm hoping that you will ask them questions or make comments on what they said, and let's have some back and forth.
My question's for Michael. Would the real estate banking industry be open to having a disclosure for tidal flooding? And if so, what audience would be most appropriate to drive that request forward in order to institute such a disclosure?
Thank you very much for the question. So the question was about tidal flooding. In other words, what disclosures would be necessary and how would that be brought about? It seems to me that would have to go more on a federal level because it's a federal mandated program through FEMA. And, of course, Florida, it's a bigger issue. And I would maybe contact your congressman. That would probably be the first place to begin on that issue.
Okay, I think everybody who went through Hurricane Andrew realizes there were winners and losers. Some people lost financially, some people gained financially.
Correct.
So as we move forward in these types of events and we structure purchases and mortgages on houses and people are going to be buying old houses, how can we incorporate this sort of rebuild, relocate decision? Because a lot of people, like after Hurricane Katrina, they might have owned their houses, but they could not afford to rebuild to new housing standards. So if you have to rebuild after a hurricane and you have to build up on stilts, or you have to elevate your house, or you have to put in new impact windows, all of these are very expensive. So how are we going to build that resilience in for the individual homeowner? And how are we going to develop a tool for the individual homeowner to know, I should just take my money and relocate, or I have the financial, I have low credit card debt or whatever else that I can now finance a rebuild, which is going to be a more expensive house, right?
Correct. Good question. So with the insurance and what happens normally with the homeowner's insurance, there is a cost for improvement because they realize we all went through that when all of a sudden plywood was $10 a sheet and all of a sudden it goes to $20 because the demand is exceedingly high. And so it's important to have, the insurance is the first backstop because unfortunately a lot of consumers, they may not have a line of credit on their existing home or they may not have enough equity. They're just getting into the home. This event happens and they're relying mostly on the insurance industry. Now, I can tell you from experience, trying to make a claim with Allstate, it took me 3 years to finally try to come to an agreement and settlement. Luckily, I had the wherewithal and to keep it, fix the house, and eventually I got a claim settled, but it was through a public claims adjuster. So that's not an effective way, in my opinion, to operate a business or have a homeowner, have a home. So one of the panel discussion came up earlier, and I believe John had said they're doing it with commercial, about having multiple years of insurance and have that as maybe as a formula. It's not being done now with residential or talked about because it's year-to-year basis, but it certainly would be great to be able to have some stability, maybe buy a 5-year insurance plan or a 3-year insurance plan. You do that with life insurance, why can't you do it with homeowners insurance and built in a cost in case there is a big storm for repairs?
Simple question, I'm just curious, Wendell and Ed, does the solvency of the property owner affect bond ratings or municipal planning?
On a macro level, yes. On a micro level, no.
One of the things that's happening demographically, we are becoming more denser. I mean, yeah, it's a function of not being able to grow out anymore, but it's also a function of transportation. It's also a function of the millennials wanting to move into a more urban area. We are becoming a cosmopolitan city. Okay, I've heard from multiple people, investors from different countries, tell us that they view Miami-Dade or Miami as being a city akin to just after New York and Los Angeles. So that's good and bad. It's good for people really interested in moving on over here, and we welcome them. But I guess the trend is not so much single-family home buying out in the suburbs. It's more of condo buying or renting on transportation lines. Again, that helps all the cause here. Someone did say to me not too long ago that we had great foresight that when we built Metro, it was elevated. But that decision back then was roundly criticized by Ronald Reagan, saying that he could have afforded giving everyone a Cadillac instead. So you never know what the future pretends, but again, we're talking, and the more minds working on these problems, the better.
Since we're referring to financial markets in the macro level, we would have to recognize the FPL, the SEC's decision for a statement by FPL, but not meeting BFE standards and their turkey plans, and the fact that the SEC made the parent company make that statement on their financial statements, and how that affected the financial markets, and how will that trickle down further to municipalities and other private markets.
So your question is if utilities are not complying with base flood elevation criteria?
Since you guys are talking about municipal funding, you can't disregard the utility, the connection, the relationship with the utility and the municipality. And if the municipalities now are being required to state their limitations or inability to meet current code elements, it has a financial effect on them immediately. The next effect will be how it will affect the municipalities and then the citizens and residents.
Do you want to share influence of utilities resilience on bonds and?
Sure, I can talk a little bit about I think the ultimate question there is disclosure. If they didn't, clearly the SEC has a much stronger input and oversight of the corporate market. On the municipal market, the SEC doesn't directly regulate. It's prohibited from directly regulating municipal bond issuers. It regulates them on the periphery. It regulates the underwriters. It regulates the municipal advisors. It now regulates the rating agencies. However, there are anti-fraud provisions that are applicable, so that if there are risks that an investor would need to know, local governments need to disclose those risks. And in order to be comfortable with that, local governments tend to hire disclosure counsel, whose sole job is to go through the risks and make sure they're presented well. So I'm going to toss that over to any disclosure counsels in the room. Oh wait, there aren't any. But that is a balancing act. To date, we haven't seen that because there's liquidity, there is insurance.
I have the world's greatest respect for the powers of the SEC. As finance director, I firmly admit that. We will disclose what we know to be facts that are material to the payback of the debt. We will disclose what we can quantify. But if things are not quantifiable, or I can't disclose it without misleading the investors who may be purchasing the debt. Now, on each and every one of our credits, be it the airport or be the water and sewer, we look at what affects their revenues, okay, and their ability to pay back the debt. So to the extent that anything, and I don't want to pick on FP&L, but on anything that's ultimately going to impact us and that we can quantify and we know all about it, it will be disclosed.
Okay, great. Our last question, please.
Sure, I actually have two questions. And first, I want to talk a little bit and hear your input on this whole issue of cash buyers, because the cost of insurance, certainly in my community, sometimes can be more than what people pay for their mortgage. And in my case, it's more than what I pay for my property taxes. And when communities then start getting more and more folks buying for cash, what does that do to a workforce which tends to be younger and tends to not have the resources to pay cash? We talked earlier, I think Alex brought up earlier, that our pipeline for new workers to support all of us who are aging is much smaller than those of us who are aging. So what impacts financially does it have when the people who actually run the communities can't afford to live there anymore, partially because of insurance and partially because cash buyers have gobbled up that property that they want to? So that's my first question, the impact on workforce. And then my second question is also related to flood insurance, and you talked a little bit about the PACE program. Right now, the PACE program it's only for wind mitigation and energy efficiency, which tend to go hand in hand. But what do we think are the possibilities for expanding the PACE program to allow folks to mitigate for flood, including elevation?
Okay. I'll take the cash question if that's okay. Okay, so the question about the cash buyers, how does that affect the workforce locally? So a lot of the cash buyers, you have several different types of cash buyers. One of them is a speculator cash buyer who's going in, fixing up the house, and then turning around and selling it to the retail market, which in a way is not a bad thing, because a lot of homeowners don't have the ability to fix roofs or go ahead and change windows or doors. So that situation, there is a void that is kind of a good thing that's happened and also brought up value. So that part is good on the one type of cash buyer. The other type of cash buyer would be, say, a foreigner coming in overseas. A lot of times it's political reasons. We'll just say Venezuela. They need to get the money out of Venezuela and put the money into a safe haven. And a condo in South Florida, Miami, is a good place to put the money, because they can leave it there. It's empty, and they can kind of come and go. It's transparent for them, and the money is, in their mind, the money is parked on Miami Beach rather than parked in Venezuela bank, where they are restricted to take the money out. So that's why you're seeing tremendous amount of growth the last several years with foreign money cash buyers coming into the area. Now, to answer the question with the workforce, why that's a problem, and the younger generation coming in, graduating, say, FIU, and there is not a job available for them right off the bat, right? They don't have experience, so they have to move back in with mom and dad. Mom and dad are glad to have them for a while, but then enough is enough, right? And eventually they got to stand on their own 2 feet. And if they start renting, because now they're getting, the opportunity is not there for them to purchase, because they keep getting bought out, they're up against cash buyers and other people putting more money down, it limits what they can do. So that what I'm saying is more and more people are moving in together, cohabitating longer period of times. So what happens sometimes is the parents will say, okay, we'll go ahead and help out with the new purchase for our children. So let's say they do a cash out refinance as an example, and then they're in a situation where they're a cash buyer. So they're like on equal footing. They go into the house as a cash buyer, and then the children are in the house, and then they can refinance the home, right? And then basically pay back mom and dad from their initial investment. So some of that's happening.
Excellent. Well, thank you all. If everyone will join me in thanking our panelists, I really appreciate the introduction.